with us around the table, Amanda Lynam of BlackRock. Amanda, good morning to you. It's good to see you.
Thank you for having me.
Let's get to this credit market. How sensitive has this credit market been to the growth scare of the last 4 weeks?
It's been incredibly sensitive, and I think you can see it both in the widening that happened during the early part of August and the very swift snap back. And I think what that shows you is that the credit market is sensitive to the growth backdrop, especially high yield and leveraged loan issuers in the credit market, not just the cost of capital and the interest rate environment. Starting trading yesterday morning, we had retraced the entirety of the early August widening. We saw almost a record day of new issue supply yesterday in the corporate credit market, so spreads have gapped out a little bit wider than that, but we're still in this kind of narrow range. We're seeing widening get bought by investors. I think the key for credit investors is that, one, yes, the forward path of monetary policy matters, but the reasons behind that rate cut really matter. And then two, we don't need really strong growth in credit to remain resilient. We just need trend or slightly above trend. And I think there's really a wide chasm between a recessionary outcome and the current pace of above trend or slightly above trend growth. And we live in that space in between.
You noted the recent round trip. How symmetrical was the widening versus the tightening beneath the surface? What led and what lagged?
So actually, a kind of higher beta cyclical sectors led the tightening, but it wasn't uniform. For example, triple Cs are still underperforming the overall broader index tightening. But this has been almost a low-quality rally in that high yield and leveraged loans have been outperforming their investment grade peers over the past few months. That's continued the year-to-date trend. And so for all of the talk about concerns about downside risks, I think investors are making the calculus that are saying, okay, I'm entering at pretty attractive all-in yields. Growth is slowing, but it's not slow. And therefore, the outcome for corporate credit investors can be quite resilient in that backdrop.
What are you personally advocating for?
Yeah, so I think there have been a couple asset allocation shifts that have been super relevant. The first and foremost has been the trade-off between high yield and leveraged loans. For most of this year, that equation was very clearly in favor of leveraged loans because of the rate backdrop. I think it's now shifted more neutral between high yield and leveraged loans. That's one. Two, the recent volatility has showed us how quickly the market can change. That's especially true for the borrowers that may have found that they were locked out of the market even just for a short period of time. So I think we've seen more interest from investors on kind of private capital, something that's not at the whim of the public market volatility. And then three, I still like moving down in quality within the investment grade spectrum. I think one of the key developments since the pandemic is that cliff between downgraded from IG to high yield isn't as severe as maybe we would have thought several months ago. And so if you can own BBB rated firms that have a strong incentive to stay investment grade, and even if they do fall to high yield, will likely be supported and bought, I actually like that. So I think within IG, moving down in quality makes a lot of sense. Within high yield, I would not go all the way down in quality to that triple C cohort because they've lagged.
When you say the corporate credit reaction to the cuts is more important, aka normalization or easing, because they're actually seeing the deterioration in the economy, that scenario is not reflected right now in valuations. What would it take for that scenario to be reflected?
You're exactly right. I think 316 is where we are on the high yield index. That's nowhere near even the post-financial crisis average. So what we are baking in at the moment is truly a pretty benign outcome for credit. I think, as Stephanie mentioned, you would need to see deterioration in the labor market, the growth backdrop that is consistent with the weakness that we saw in July, such that it kind of spooks credit investors that growth is not even at trend, but actually meaningfully below. That's really the critical factor. But again, so long as we have trend growth, companies have shown that they've had an ability to navigate this cost of capital environment. And so really, it's an extreme downside risk to growth. Now, I think the important thing for investors, though, is there is a lot of room for spreads to widen. In such a scenario where we're kind of nearing kind of not recessionary levels, but a sharp slowdown, I think you could see spreads go to 550, 600 from 316. So there's a lot of room to widen.
You've got your finger on the pulse of this market. I think an interesting question for Friday would be how sensitive this market would be to stronger than expected data versus weaker than expected data. What would generate the larger move?
I think weaker than expected data because it feels to me like stronger than expected data is almost priced in at the moment. I realize that GDP can be revised and third quarter's tracking at 2%. So I would say that's not extremely above trend, but we've had resilient growth all year. And I think the consumer has surprised to the upside in terms of spending, albeit bifurcated.
Just quickly, on supply, you mentioned it. The amount of supply we've had in the last 24 hours, the announcement of companies bringing debt to market. Are they operating from a position of strength or weakness or stress?
A position of proactivity and strength. And Stephanie had mentioned kind of capital spending slowing, but capital management has not slowed. And so companies, I think, are being proactive in terms of capital management and the balance sheet as they move towards later in the year in the event risk.